Let's get in Vikas Khemani, CEO of Edelweiss Securities, joins us on the show with his perspective on the markets. Vikas, how are you looking at trade right now? Do you think the market will pretty much adjust itself in a range after this strong pullback or short covering led rally?
Yeah, hi. I think yes. I guess this sharp rally, in the recent past has actually, sort of extended back by some of the short covering, and I think people who were underweight kind of jumped in the markets. And I do feel that at these level markets will have to consolidate. I think further good news will have to come to sort of drive it from here, and I think that will have to be more in terms of numbers. So far obviously stability in the rupee and also some amount of stability in overall emerging market currencies have helped the sentiment, and I think a lot will depend on what comes out in the monetary policy on 20th, and also how the number follows up. But I do feel that investors would be cautious at this point in time here, because I think a lot of it is priced in at this level. A lot of uncertainties can still lead to some market corrections. So I think what we've been seeing is some amount of profit booking has been coming at these levels, and I do feel that stock specific and sector specific activity would be there, but at index level you will see some amount of consolidation here.
Because in dollar terms, Indian markets have appreciated by about 13% plus from the recent low. So what are you advising the clients? Should they use the rally to their advantage to cash out, to lighten up?
I think Nikunj, at this point, I mean, we've seen a significant correction and market recovered. So in that sense, in the recovery, people who were underweight in the market, I think ended up sort of buying a little bit more. But I think probably by and large, most of the institutional investors have been holding on to their positions. It's just that realignment of the portfolio has to be done, and at least we've been advising investor to, I think, stay away from the banking sector or from overweight position. I think stay neutral or underweight on the banking position, because I think that is where, especially in the PSU sector, still asset quality issues are not over, and we think that this volatility will continue. While there is some cheer, some good news which continues to be there, but I think a lot more uncertainty, lot more volatility, lot more events are there, both local and global, and I think that will have impact on the sectors like banking, and I think that is one key sector one has to really play carefully, and we've been advising to sort of reduce exposure on this sector. And others, I think from a long or overweight perspective, we've been kind of very positive on IT, given the global growth coming back, rupee weakness, and I think overall defensiveness of the sector. We've been very positive on pharma. So I think it is against more sort of sector specific realignment of the portfolio we've been recommending, rather than taking a big call based on only a 13% sort of move in the portfolio in the markets.
How are you approaching some of the investment-led themes, especially cap goods right now, Vikas?
I think definitely there is a little bit of case which is being, or the case is being made that I think if you believe that economic cycle is or capex cycle is close to bottoming out, and valuation of the stocks are looking interesting and attractive, I think we have done a lot of work on that, and we feel that we are close to bottoming out of the cycle. Now how long it will take in terms of panning out might be slightly longer than expected, but I think there is a risk reward which is sort of getting in favor of looking at some of the industrials and capital goods names, and I think we've done a lot of work on that. I think recently we've also sort of done in-depth work on Larsen and Toubro, and we put out a report under Wwatch series, and where we mentioned that I think the stock risk reward is in the favor from here on. The order book is accreting but slowly, and I think a large part of the order book is, I think, now on track in terms of execution. While overall environment is slow, hence the sentiments are bad, but I think if you look at slightly long-term picture or slightly recovery in sight, then I think capital goods or industrial stocks can look attractive from here. So I think incrementally we've been advising investors to look at stock specific, to look at company, and I think what sector they are exposed to, and I think make selective bets in terms of capital goods and industrials.
Because what happens if next week the Fed outcome is favorable, which is Fed decides to taper light? So if the outcome is favorable, what could be the best case scenario for emerging markets and for India?
No, I think, see, tapering is probably more or less, sort of factored, priced in, and I think taper light, or, I think, there are various views. Some people believe that, tapering would be light. Some people would believe that, tapering, could be sort of a little bit more accentuated. So I think, I do feel that if tapering is sort of given, or tapering would begin in some sense or other, and the large part of the impact that has been factored in. If it is taper light, probably market will, especially the emerging market would rejoice in the short term. You will see, currencies recovering, but I would say that would be probably a short-term phenomenon. And I think Fed will try and basically, get into the tapering by sensitizing the market. So I think they first did by sort of making some statements, and I think which already sensitized the market across the globe. And I think probably that was their objective, which they achieved, and I think that's how they would probably deal with it. I don't think the idea would be to sort of give knee-jerk reaction to all the markets and kind of have a systemic kind of risk. So I would say it will be more like a taper light kind of situation, but at the same time I think you might see that's a little bit of rejoicing which already has been seen in the emerging markets, and I think that might continue for some more time. But again, I think over a period of time it has to get readjusted, and with this readjustment phase is going on, and I think in a longer term, in a medium term to longer term, emerging market currencies would remain under pressure. Dollar will keep on appreciating. That trend, I think, is here to stay. It's just that how do you sort of pan out? How does this trend pan out from a short-term volatility perspective? So, I mean that is one thing one has to play out, and most of the emerging markets, I think, will have to adjust to their productivities or improve on their productivities in terms of being more competitive, and I think in terms of holding on their currencies.
So because what is a good investment in this kind of a market? Because by the time core fundamentals would improve, stock prices would have appreciated. I mean, if you wait for the robin, the spring's going to be over.
True. No, I think so. Again, there you have to have a balanced approach, Nikunj, in this. Some part of the portfolio you have to have which is, defensive, and you're not aligning to only one side of the argument. So as I said, that we are sort of, at least of the view that IT, pharma are the two sectors which are sort of defensive, also aligned to the global growth, and which will have to have in the portfolio, which will also, I think, provide both growth as well as the defensiveness of the portfolio. And other side, we are saying, I think, look at the stock specific, slightly out view, as I said, that in the capital goods industrial space, where I think valuations are not very expensive, and I think companies are solid, balance sheets are not broken, and as the environment changes, you will sort of see that kind of recovery coming back in that. And as I mentioned, Larsen & Toubro is one such case we had recently recommended, and there are many such sort of story in infrastructure space, capital goods space, where balance sheets are not broken, and I think long-term strength of the business is good. And we have advised investors to start beginning to look at these kind of sort of stocks. If you have appetite of slightly higher risk, we see a lot of value in the mid-cap space. I think large-cap stocks have rallied in the recent past, but I think mid-caps have still been ignored by the market by and large, rightfully given the current environment and the volatility in the environment. But I think as if let's say tomorrow your recovery were to come, I think a lot of mid caps which are extremely cheap and underpriced, they would definitely give superior return. So one has to look at again that space in a sort of on a serious note if you were to sort of make the investment slightly contra-cycle.
Fair enough. Vikas, give us your outlook on the consumption space right now, and how much weightage would you assign to the sector in a portfolio?
See, I think one very clear theme which is emerging out in consumption is I think the slowdown of the consumption which has been underway, and I think so you have a classic high valuation and over ownership in the stock by the institutional investors, and also you are beginning to see somewhat slowdown in and it is not a negative growth, but it's a slowdown of the growth, a deceleration of the growth. So I think you will see somewhat as the environment changes, as it will change. So it again depends on how fast and when the environment changes. But we do think that risk reward of remaining significantly overweight or invested heavily in consumer is not favorable. We've been advising investors to reduce the consumption stocks, and I think look for some of the stocks where there's a value and slightly counter cyclical, and I think that is where I think risk reward favors. So, and again, having said that, I am not saying that these companies will continue to do well. They'll high, good balance sheet, good companies, they will grow. But at the same time, from market perspective, they might not give the return, what probably would be expected from either overall index or, other rest of the sectors. I mean, similar trend we had seen in post 95 to 97, 98 kind of consolidation. In that period also, in consumption stocks had sort of gone to high multiples of 35, 40 times PE, and post that, when the rest of the sectors did well, I mean, consumer stocks delivered absolute return, but they did underperform. So, that's the similar trend I see. If recovery happens, consumer stocks would definitely deliver absolute return, but they might not, deliver outperformance.
Wockhardt up 47, Ajanta Pharma up 18, Strides up 14 rupees, and there is positive price action in Dr. Reddy. So pharma, I wouldn't say across the board, but selectively pharma is having a good day. There is price action in Hero MotoCorp, which has been a very smart and a trending stock. The real logic in Hero MotoCorp is that this is one company which will benefit because of rural demand, and if economy slows down, downtrading in the economy will start, and the consumer preference will shift from high-end products to medium-end or the low-end product. Because whereas the urban part of the economy is slowing down as no job creation is happening, inflation has kicked in, the rural end of the Indian economy is not slowing down. Monsoons are strong, MSP prices are poised to go higher, food security bill has kicked in. So what is the best way to capitalize on the growth of rural India?
I think, one, I think the clear sort of focus item is to play on agri and related sectors. So that is where I think, since monsoons are also good, and I think, so clearly to play agri and related sector is the best way. So I think, seeds company, agrochemicals companies are, I think, very best placed in this. That is one segment. Second, I think, is tractor players such as Mahindra and Mahindra. They've been doing very well, and I think also they have a lot of, other than tractor, also rural portfolio. So I think that stock is something what we've been recommending, to sort of have a quasi play at the rural consumption, rural growth, and also somewhat play on the upcoming elections, because that is where a lot of the vehicles get used. So I think that is one stock we've been recommending from a next 6 to 12 months perspective in that space. Other than that, I think one has to sort of look at some of the ideas in the micro irrigation space, which I think the growth has been coming back. So I think agri related and somewhere around tractor space is what we think is the best place to play the rural demand at this point in time.